Hi everyone. Sorry about the delay today in terms of a slight scheduling issue just between Berlin time and Australian time, but we're on track now. So we've received 4 questions today, but also I wanted just to talk about some research that Alex and I have been reviewing in relation to COVID-19 and the impact on share markets. So the very first question today, let me bring it up on screen. So the very first question today, what are the thoughts about differences between markets around the world, Australia versus the US versus Asia versus Europe? And as many of our longer term clients know, this is something that Alex and I review on a regular basis. And what's interesting to see is COVID-19 hasn't had an impact on the relative value between each of these regions around the world. All it's done is it's made shares more cheap than what they were a couple of months ago. So Australia and particularly Europe are looking quite cheap at the moment. Asia a little bit less so. And the US, which was overpriced, is now just looking at being fully priced. So the US is something that we wouldn't necessarily be recommending at the moment, but certainly from a valuation point of view, Australia and Europe are still looking cheap, just as they have been for quite a period of time, just more cheap than what they were a couple of months ago, as I mentioned, and Asia to a lower extent. But I guess continuing on from that, I did want to share some research that Alex and I have been reviewing in relation to the potential impact of COVID-19 on markets. And what this research has looked at is to really sort of say, okay, what are the possible scenarios on markets and the economy over the next 6 months, 12 months, potentially 18 months? And what sort of impact will that actually have on markets and for investors? And it looked at 2 particular scenarios. The first scenario that it looked at was the short, sharp shock, where everything sort of happens quite quickly, but companies are receiving support from the government. The COVID-19 outbreak is managed quite well, and there's a general easing of restrictions, nothing too fast, nothing too quick, and that there's an increase in the market and economy again. This second alternative, which was looked at in a little bit of detail, was sort of a doomsday scenario. So, what if the worst case happened and sort of everything went even worse than what it has been, and we sort of end up in that worst case scenario. And then, of course, it sort of just considers the in-between scenarios as well, which is also a possibility. It's still sort of saying the short, sharp attack, sort of based on the research that we obtained, is still likely about a 50 to 60% probability of that happening. But again, it does depend on how governments around the world do manage COVID-19 in terms of supporting businesses, as well as the general easing of restrictions and managing it back on a careful basis. And the sort of doomsday scenario is sort of looking at a maybe 10% scenario, with everything in between sort of making up for that other sort of 40% or so. And what it's essentially saying, in either case, as a long-term investor, you're still better off to be fully invested. And that's particularly given when we're comparing what interest rates are doing. So if you're a longer-term investor and you have the ability to sort of withstand the current volatility, and you don't need your money in the next couple of years, then if we're looking at that longer term, you are definitely still better off being invested, particularly given, as I mentioned, interest rates are still low. So if you do keep your money in the bank account, for sure you're not going to experience the volatility, but you're also not going to get very much income return on the money sitting there. Compared to having the money fully invested, if you can withstand this volatility, you're going to get the income in terms of bond returns as well as dividends on shares along the way, which helps boost the overall return. And even looking at the doomsday scenario, again, it goes back to your goals and what you're needing that money for. And so particularly if you're just building a portfolio to essentially live off the income stream. So if you're either adding to the portfolio, it's great to stay invested, because if the markets do stay a little bit depressed, you're buying in at lower prices. And at the end of the day, if you're building up wealth for financial independence, it's not so much the value of your portfolio that's important, but the income that's being generated from that portfolio. As we've always said, if you're someone who's building up an investment portfolio for a specific goal in the next 1 to 2 years, then investing in the share market probably isn't for you anyway, because there's an imbalance between your investment time horizon and when you need that money, and sort of the time horizon that we generally recommend for longer term investors. Now, of course, there has been talk about dividend rates reducing, which is highly likely, but then in Australia, dividend yields have been relatively high for a period of time. And the research that we've been looking at has actually compared what the impact of reduced dividend rates would be in terms of total return in both the short, sharp shock scenario, scenario 1, as well as the doomsday scenario. Now, for sure, it has a bigger impact on the doomsday scenario. So the doomsday scenario does, of course, have lower returns than the short, sharp shock. But the impact isn't as great as what many investors might fear. So it really is looking at that combination of capital growth as well as the dividend income. But a reduction in the dividend rate doesn't really impact the overall strategy. It just means a little bit less return. So in terms of the other 3 questions that we've received, so one of the questions that we've had is, Caroline has mentioned ETFs. Are there any particular ones that Summerhill recommends? Now, the ETFs that we recommend are, of course, in Summerhill Invest. So we've created in Summerhill Invest a portfolio of ETFs designed to be low cost and broadly diversified. By logging in, sort of going in and sort of completing the risk profile on Summerhill Invest, you get access to those ETFs that we recommend as a portfolio that is then completely professionally managed, rebalanced on a regular basis, complete with a tax statement at the end of the year. So certainly in terms of those ETFs, we're not big fans of just buying single individual ETFs. Much prefer to see them on a portfolio basis and having sort of broadly diversified ETFs, not just across industries, but also across around the world as well. And then getting that mix right between shares and bonds, depending on what your risk profile is and what you're comfortable with in terms of taking risk, as well as what your investment timeframe is. One question that we received from a relatively new investor is there a risk that I would lose all of my money if I invest in ETFs? Now, this is actually one of the benefits of ETFs, and particularly in periods such as this when we're going through an investment crisis. And of course, there's so much volatility. It's, you can never say never. No one can predict what's going to happen tomorrow. But you're minimizing the risk of losing all of your money by investing in ETFs because you're investing in a basket of stocks. You're not investing in 1 or 2 particular stocks. And especially as a relatively new investor, when you're just sort of building up a portfolio, it's really hard to have good diversification within 1 or 2 stocks. You're really sort of taking a bet and hoping that that particular company does well, which you don't have to worry about when investing in ETFs. So in terms of answering this particular question, I can't say that you would never lose all of your money by investing in ETFs because anything is possible, but the risk is absolutely minuscule, especially when just investing in a basket of the market ETF. So you're investing in the market as a whole. You're not investing in a specific theme or a specific topic with an ETF portfolio. Then the risk is absolutely minuscule in this regard. And then the last question that we've received for this week is, how do I receive a return when I invest in ETFs? And this is, again, from one of our newer investors, and it's really the same as a stock. So with any investment, whether it's a bond or a stock, there's 2 forms of return. And the first part of the return is either capital growth or capital loss, as the case may be, depending on the investment, whereby you buy an investment for, say, $100, and then it grows in value to $110. You've made a capital gain there of $10, and that's one aspect of the return. But the other aspect of return is the income that you receive from the investment along the way. And that's really important, particularly during periods of volatility, such as what we're going through now with COVID-19, whereby the value of your investment may be quite bumpy along the way, but particularly when you're invested for a longer period of time or you're building wealth to generate a future income stream, then it's not so much about the value of the portfolio, but that income return that's really, really important. So when you hold ETFs, you receive all the dividends that the shares pay out in that ETF portfolio. So depending on what dividend rate each individual share in that ETF is paying, you actually receive that as an ETF unit holder. And that includes the franking credits as well, which can make Australian share ETFs just as tax effective as holding those direct shares. That's pretty much it in terms of the questions that we've received today. Would be really interested if anyone has any more questions, always more happy to ask. We'll be doing our next session in 2 weeks' time. If you have any particular questions or comments in relation to the research in terms of talking about the two different scenarios, scenario one, short, sharp shock that I talked about compared to the doomsday scenario, more than happy to look at that as well. But this sort of research is something that Alex and I sort of look at in quite a bit of detail behind the scenes to make sure that we're staying on top of everything, but also just making sure that the advice that we're giving is still relevant to all of our clients and taking into account what type of, what the potential outcomes are. No one knows what is going to happen tomorrow. The best that we can do is be prepared for different outcomes, and based on what the different potential outcomes are, is take action now to protect any positions and sort of manage those positions effectively. Great to chat as always, and hope to receive some more questions from you. Thanks very much.